So it's Tim Hart here from Private Mortgages Australia. I'm one of the directors, and I really want to talk to you a lot about private lending, how it works. It's something we're seeing a lot more brokers use in the industry, especially as the banks become harder and harder to deal with. So I just want to go through also how we've broken down and become channel agnostic, and I'll explain what that means in a moment. You may have seen a recent article that was written about us on Australian Broker, and just how we're doing things a little bit different and making it a real win-win for our brokers and really looking after them when they refer clients to us. So let's get started. You'll see the first thing, this is our list of products. And the first thing you'll notice is that we do business finance. Okay, so we don't do funding for mum and dads that want to buy their own home. We don't do any coded lending. We do first mortgages, second mortgages, and also caveat second mortgages when we need to settle really quickly, and we can only settle on a caveat. We don't have time to register the second mortgage. So we've got our rates there. So anything for our first mortgage, anything from 1 to 2.5% per calendar month. Okay, so our loans are very much designed to be short-term in nature. So you'll see our terms are anything from 2 months up to 36 months is the maximum term that we'll allow, and anything from $50,000 up to $2 million will do for first mortgages. Second mortgages, they are a little bit obviously more risky because we're sitting second place, so the interest rates are slightly higher, and we'll do anything from 2 to 12 months and anything up to $1 million. And our caveats are anything from 3 to 5% per month and a maximum term of 6 months and a maximum amount of $500,000. So they're the three products that we have in the marketplace. And the main thing being is it must be for a business purpose. The other big question we get asked is, well, how much will you actually lend one of my clients? And so this is the table that we base our loan to value ratios from. Now we actually break it into 4 different categories, and these are based on the Genworth financial postcode categories. So if you're not familiar with it, the category 1 is most properties are in category 1. Anything that's within, say, 40 to 50 k's of a Melbourne, Sydney, Brisbane is usually category 1. Category 2 is more your main major regional towns. Category 3 is maybe your smaller regional towns, and category 4 is we affectionately call whoop whoop, is a property that's in the middle of nowhere, and you'll find that most banks won't actually lend in category 3 and 4. Okay, it's just too far out. And but as you can imagine, we lend less and less depending on where the property is and how quickly it is for that client to be able to sell that property or refinance it, depending on their exit strategy. The other thing you'll notice that we've got on the left here is a maximum. So even though we might, for residential category 1, we'll do 75%, we actually have discretion to go up to 80%. Okay, because private lending is all about flexibility. Okay, we're not like a bank that just has a little box that you have to fit in the box, and if you don't, well, the loan declined. We're all about coming up with solutions that's going to get your client the solution that they're after. So we do have discretion to go up a little bit higher in LVR, provided it makes commercial sense. So maybe they've got the property sold, or they've got some additional security, or or they're very experienced client that we have that discretion to increase the loan to value ratio on. Okay, the next thing that we always get asked is, what are the other fees and charges? Because a lot of the time it's not just about the interest rate. We want to look at what are the other fees and charges that the client's going to need to pay to get a private loan. So the first thing that we charge is an assessment fee. So this is the only fee that we charge up front, and it's usually $550. Sometimes it's up to $770, depending on how complex the transaction is. So if you've got, the client's got 10 properties and there's 3 different entities and all the rest of it, if it's a very complex deal, then it's probably going to be at that $770 mark. Basically, that's enough funding to cover all our title searches and credit checks and do all the due diligence that we need on the file. In the event that we need a valuation, which we don't always need, but we do that at cost, so there's no margin at all on that. And same with our legal fees. At Private Mortgages Australia, we like to make our money by lending money, not by upfront fees and costs and the like. The only other fee that we pay is an approval fee. Or the fee that we charge is an approval fee. So you can see it's sort of tiered based on how much the person is borrowing. So if they're borrowing less than $100,000, there's an approval fee of 4%, and of that we pay 1% to our referrer. So included in that approval fee is a 1% referral fee. Now, we've actually become channel agnostic, meaning that it doesn't matter if the client goes through you or they come to us directly, they're going to get charged the same amount. Okay, so that means that there's no benefit in your client circumventing you and coming directly to us. They're going to be charged the same amount of money. And you can see that as the loan size gets larger, so anything over $1 million, the approval fee drops down to just 2.75%, and of that, 0.75 goes to our referrer. Now, that's not the only way that our referrers get paid. We also allow referrers to charge a service fee. Okay, because as you know, most of our referrals come from our mortgage broker channel, and you know, there's a service that you're providing to that client. So we allow you, in addition to the referral fee that you get paid, you can charge that service fee. So it might be, hey, I want to make another $1,000 or another 1% or whatever it might be. Or you can mandate your client directly. So if you've got a mandate, we'll just pop that onto our letter of offer to make sure that you get paid that as well at settlement. The other thing that we've done, that I think we're the only lender that I know of that does this, and that featured quite heavily in the article that Australian Broker did on us, is that we'll actually pay a subsequent referral fee even if the client comes to us directly. Okay, so if you refer John Smith to us, we do a loan, and then 5 months later he says, PMA, hey, I'd like another loan from you. The first one went really well. What we'll do is we'll proceed with the loan, and then we'll contact you and say, hey, can you invoice us for the 1% referral fee or whatever it might be. It's always a bit of a buzz for us when we get to contact one of our brokers or referrers and sort of say, hey, can you send us an invoice for $2,000, $3,000, $4,000 when they haven't actually done any work. And this is a way for us to thank you for bringing the client to us in the first place. Now, the only circumstance where we wouldn't pay a subsequent referral fee is if there's another broker that has sent the file through. So if it's the same client but it's a new broker that they've gone to, then obviously we have to respect that new referrer and we'd send it through. So it's only if that client comes directly to us. The other thing we have is what we call our referrer rewards program. So it's just another way for us to reward our referrers. It's a bit of a mouthful, but this is what it looks like. So basically, the more that you refer business to us, we'll send you out just little gift cards, just another little way for us to say thank you. So as soon as you've sent a loan of $500,000 that settles, we'll send you a $250 gift card. Now, we've got some examples there of, say, a Myer gift card, Dan Murphy's Flight Centre, whatever gift card you like, just let us know and we're happy to send you one for that particular institution. Now, the next one you'll see is $1 million. You'll get a $500 gift card. I want to just point out that these are cumulative. So let's say you sent us a loan for $2 million. Then you would get a $1,000 gift card plus a $500 plus a $250. So you'd actually get $1,750 worth of gift cards in addition to your share of the approval fee plus your referral fee as well. The top tier we have is a $3 million where you'll get a $2,500 gift card, but you also enter what we've called the lifetime membership into PMA's Platinum Playground. Okay, so you're a premium referrer, and every single year we'll give you a $500 gift card provided you settle at least $500,000 worth of loans with us. So this is just another way that we're rewarding our referrers. So let's get into, I suppose, understanding short-term lending, how it works and how our process works. What we do is once you submit either an application form or our one-page quick app. So if you're not familiar with our one-page quick app, it's exactly that. It's a one-pager where you tell us the real high-level details of the deal, and just off the back of that one pager, we can actually do our initial assessment and provide you with an indicative letter of offer. Okay, so it's really just streamlining the process and making it really simple and quick for you to get an offer to your client and say, hey, here's what it would cost if we went through and got a private loan. Once we get that, we will issue our indicative letter of offer, which will have our indicative rates on it and all the fees and charges. And it's at that point that the client would need to pay the assessment fee. Okay, it's only when they accept the indicative letter of offer that they need to pay the assessment fee. If they don't accept it, then it hasn't cost them a thing. Soon as that's been paid, we will then finish our due diligence. We then proceed to the formal letter of offer. Once the formal letter of offer has been signed, we get documentation done and it goes to settlement. Okay, so it's designed to be a very, very streamlined process because private lending is all about, I mean, it's about flexibility, but two, it's about timing. People come to us because we can act quickly and we can sell a loan in 1 week, 2 weeks. We're not going to take 4, 6, 8 weeks like a bank with all their stringent lending criteria as well. So let's look at what we look at to qualify a deal. Okay, we like to let our referrers know our process, so you can actually qualify your own deal before you send it through to us, just to make sure that it's not going to waste your time, but ours as well. So the very, very first, we call it the first filter. The very first check that we do is the loan non-coded? Okay, so let's look at what do we mean by non-coded. Okay, so it has to be a commercial loan. It can't be mum and dad looking to buy a jet ski or go on holiday or buy their own home. Okay, so the first thing we look at is who is the borrower. So if it's a corporate borrower, so if it's a company that's borrowing the money, it's automatically deemed to be non-coded. Okay, so they're nice and simple, and that's probably the majority of our borrowers are borrowing through a corporate or a company structure. If the borrower is an individual, if it's for domestic purposes, it's coded and we can't do the loan. For us, if the borrower is an individual, the loan purpose, more than 50% of the funds need to go to a business purpose. So more than 50% of the money that we're lending them has to go to, I don't know, buying a business or buying a commercial property or something like that for it to be deemed non-coded. The other thing we look at is the type of security. So if the type of security property is a commercial property, once again, it's automatically deemed non-coded, nice and easy, we can definitely do the loan. If the type of security is residential property, we need to make sure that more than 50% of the loan funds are used for a business purpose. So just keep that in mind. That's the very, very first thing we check to make sure whether or not we can do the loan. The next thing we look at, number 2, is 1% per month. So the cheapest loan that we'll do will be 1% per month, or the 12% per annum. So if the client is expecting to get bank rates at 5 and 6% a month, 5 and 6% per annum, it's just not going to happen. So we want to make sure that their expectations are that the rate is going to come back at least 1% per month, and that they understand that that's where private lending starts, and that's where their expectations are, so that we're not going to go through the letter of offer and then the client says, oh, I was expecting to get a rate of 5% like the Commonwealth Bank were going to offer me, or something like that. The next check we do is postcode and LVR. So that second slide that I showed you that had the LVRs that we do for particular postcodes, so based on the Genworth financial postcode categories, we want to make sure that the client is not trying to get an 80% loan on a property that's in the middle of nowhere, okay, that it sort of meets those LVR guidelines. So if the client's looking to get a 70% loan on a category 1 location, then great, that ticks that little box. We then move to the next one. How much do you as the referrer want to get paid, or how much is your mandate for? Because what we want to do is make sure that that's noted in the letter of offer so there's no confusion, and to make sure that you get paid within 24 hours of settlement. The next one is probably the most important one, is the exit strategy. So this is how is the client actually going to repay the money at the end of the day. Now, one of the big things for us is, and one of the big reasons people use private lending, is serviceability is not required. Okay, we're more interested in the asset and how they're going to repay the money back at the end of the 4-month period or the 6-month term than the client actually servicing the loan. So one of the more common ones is maybe refinance. So the client needs some short-term money, they need it really quickly, and they need it for, say, 3 months, and then they're going to go to the bank and get their own loan. Okay, so that's quite a common one. It might be the sale of an asset, but that's something very, very key, because what we want to do is we want to make sure we're setting the client up for success. We want to make sure that we're setting them up so that at the end of the day they've got a viable exit strategy to repay the loan, and that way it's a win-win for both parties. The next one is very critical as well, is why can't the client get bank finance? Because if the client can get bank finance, don't come to us. We're very, very clear on that. If they can get bank funding, it's going to be a lot cheaper than getting a private loan. So we want to know really upfront, why can't they get it? Is it that the bank can't settle in time? Is it that it's for development funding and the bank just has too many boxes that need to be ticked? Maybe the client's got a bit of bad credit. Whatever it might be, we need to know that up front so we can know what's the issue that we're dealing with here. The last one is, when does the client need to settle? Okay. For us, private lending it's all about working with you and your client to get a solution to their problem. So if they need to settle in 2 weeks, great. Let's set that up front, that we know we're all working towards a goal. We're not like a bank that just, you go into the big sausage machine and it'll get ready when it's ready kind of scenario. So we want to make sure that we're going to be able to meet the client's expectations, be able to settle in time. Okay, so what I want to go through now is now that you know our qualifying process, I want to take you through an example transaction. And this is actually a completion finance deal. And we define completion finance is basically a development transaction, except it's towards the end of the construction. So for whatever reason, they've got towards the end of construction and something's gone wrong. They've hit rock, the builder's gone bankrupt, or they've run out of money and they need some funding. A lot of banks most banks don't do completion finance. They'll only do funding at the start of the loan before any works happen. So the scenario was, we had a borrower who bought a development site in Altona North in Melbourne, a very nice spot, just in the western suburbs, and they were doing a 3 townhouse development. The build was 90% complete, but then they ran out of money. So they were basically trying to self-fund the development and ran out of money. The borrower was a company. The experience, they had none. This was actually their first development deal. So you can imagine how much the banks loved that. The other big one, serviceability. They were self-employed and they had no financials done. The valuation, we got a valuation done and it came in at 1.95 million. So that was the GRV, the gross realization value of the project. They already had a first mortgage in place of $520,000. They had a build contract for $650,000 and they'd already self-funded $250,000. Which what that meant is they had a shortfall of $400,000 that they needed to complete the construction, and they also only needed the money for 2 months, okay, because that was how long it was going to take them to finish the construction. And then they had their exit strategy. They already had, of the 3 townhouses, they already had 2 of them pre-sold, which was going to be more than enough to repay both the first mortgage and the $400,000 that they needed to borrow from us. So when we went through and qualified the deal, we just went through that first filter that we went through. So was it non-coded? Yes, it was a company borrower, nice and easy. The borrower was happy to pay more than 1% per month. They were happy to pay 1.9 because it was a second mortgage that we were going to offer them. The postcode was category 1 because it was within 5 Ks of Melbourne CBD, and the loan to value ratio was less than 65%. The referrer wanted to make 0.6% plus GST. The exit strategy was the sale of the units, so they're 2 pre-sales. Why can't they get bank finance? I mean, the list was as long as your arm. They were self-employed, no financials, no experience, the time frame, the fact that it was halfway through construction. There was no way that any bank was going to give them the funding. And even then, most banks don't like to do loans that only go for a couple of months because they just don't make enough money out of the transaction. And when did the client need to settle? We see this quite often as soon as possible. They actually had an outstanding invoice to the builder of $330,000. And the building was actually at a bit of a standstill. The builder refused to do any more work until their $330,000 invoice was paid. So they were so close to the finish line, but they couldn't get there without some additional funding. So what we did, we came up with a solution for them, and we gave them a $435,000 second mortgage, and the interest rate was 1.9% per month. It was just a 2-month loan, and we also offered them 6 months worth of extensions. So depending on all of our loans come with extensions. Sometimes it's 3 months, sometimes it's 6, depends on the transaction. But we work in the real world, and we understand that things don't always go according to plan. So we always build in a bit of a buffer for the clients that they can just pay 1 month's interest and extend the facility for 1 month. And they can do that, in this instance, they could do it for up to 6 months if they had any issues getting the sales through and that sort of thing. The approval fee for this one was 2.6%, and of that, 0.6 went to the referrer. Now, what I want to go through at the moment is understanding short-term lending. So this is how we explain it to anyone that wants to borrow money from us, and how it's how we urge our referrers and brokers of how to educate your client, because a lot of people get really hung up on interest rates. And they think, oh, I need to make sure I get the cheapest interest rate, and that's what it's all about. And what we suggest is almost forget the interest rate. It's all about the total cost of the loan, not the interest rate. Because the total cost of the loan includes the interest, but it also includes all the other upfront fees and charges. So in this example, the interest was going to cost them $16,530 for the 2 months. The approval fee was just over $15,000. The legal fees was $2,700. So all up, this loan was going to cost them just over $34,000. Now, that can make a lot more sense to a client because it allows them then to make a business decision. Is it worth spending $34,000 on this loan to get the deal done? So what a lot of the clients do, and what we urge them to look at, is look at how much profit they're making from this transaction and see if it makes sense to spend $34,000. So I put together this, just some rough numbers for this particular development. They had a gross realization value of 1.95. They had some land cost, stamp duty, and I estimated they had some agent fees and council contributions and holding cost. All up, they were going to make a profit of around about $500,000. So the question they need to ask themselves, does it make sense to give away 7% of your profit, being the $34,000, to get the deal done? And absolutely. I mean, that's an absolute no-brainer. Would you spend $34,000 to make $500,000? Makes a lot of sense. Now, if we had a client and they were going to spend $34,000 to make $30,000, it probably wouldn't make sense and they wouldn't do the deal. So if you can see, this is a much better way to analyze a deal rather than just looking at what the interest rate is. So this is for us, this is the best way to look at a transaction to see if it makes sense for your client. So let's just have a look at some of the other things that we do. It's not just development funding that we specialize in. One of the main things is urgent funding, where a client needs funding yesterday. They need it quicker than a bank can do it. Another big one we do is asset lending. So we're not really too concerned about the serviceability of the client. It's more about their asset that they're putting up as security. Another big one that we do is ATO debts. So someone's got an ATO debt that they need paid out, because a lot of banks won't actually lend if you've got an outstanding ATO debt marked against their credit file. Another one is refinancing existing caveat loans. So maybe your client's gone and got a very, very expensive caveat loan, and maybe it's gone into default. And we've seen, people paying 12 and 15% a month on these loans. So we can come in, refinance them out to a much more secure second mortgage facility that might come in at 1.5%, 2% a month, and save the client a lot of money in that process. Something else we do is we'll actually lend on valuation, not contract price. Okay, so once again, we're property investors at the end of the day, and we understand that you can buy a property under market value and you can add value to it after you've bought it. So we'll actually lend on the higher of valuation or contract price. And we had a great example. We did a loan a little while ago where we actually lent 103% of the purchase price, because our valuation came up much higher than what they bought it for. So it's not all just about the loan to value ratio being against what they bought the property for. So that can really help, where compared to a bank that will lend on the lower of valuation and contract price. A couple other examples, it might be someone paying out a business partner. They might have an urgent business opportunity where they can maybe buy, stock for their business. They can buy it at a really, really big discount, but they need the money really urgently. So we can come in and facilitate that. Developers, yep, we deal with them all the time. We can do traditional construction facilities, but we can also, as we just went through, more of a completion finance deal where something's gone wrong towards the end of the transaction. The last thing I want to note is credit impaired. Okay, so we're not too concerned about the credit of the client. It's more about the asset that they're putting up. Now, the only time that credit would be an issue for us is if the client, if their exit strategy is to refinance. Okay, so if they've got really bad credit and they're saying, hey, I'm going to go refinance your loan in 3 months, well, that would be setting the client up for failure, and we wouldn't do that transaction. We'd want to look at an alternative like them selling the property or something else happening if they can't get traditional finance. Okay, just sort of getting towards the end here, I just want to cover sort of a borrower beware and just talk to you about some of the other things that other private lenders do in the marketplace. And what I'm going to discuss, they're not, other private lenders in the marketplace, they're not doing anything illegal. Like, none of these things are illegal, but for us, we just see them as a bit of a dirty loan, and they're just not quite right. And some of the things that they'll do is they have from rates. So they'll say, we do lending from 1%, but there's no upper edge of the rate envelope. So you don't know if that rate is going to come back at 1%, 2%, 3%, 4%, 5%. Whereas with us, you know that a first mortgage is going to be between 1 and 2.5%. You're not going to suddenly get an offer that comes back way above that. Another thing that we see that we can't stand is these big upfront fees before the final offer. So we saw one the other day that the lender wanted to charge the borrower $18,000 up front before they even gave them the final offer. So if the loan didn't proceed for whatever reason, so if the lender knocked it back for whatever reason, then they got to keep $18,000 and the borrower got nothing. They lost $18,000. Whereas us, we much prefer, we only charge that very, very small assessment fee up front. And if there's any costs that are associated, like a valuation that's needed, it's always done at cost. And we even allow the borrower to pay the valuer directly if they like. The other thing we see a lot of in the marketplace is, because private lending is all about speed, is these 24-hour loans. If you've been a referrer or mortgage broker for for more than a month, you'll know that doing a whole loan application, including documentation and settlement, in 24 hours is a big ask, to say the least. There is very, very few lenders in Australia that can do 24-hour loans. And in Private Mortgage Australia, we can't do it. We can't do a loan within 24 hours. Most of the stuff, the quickest stuff we can do is within about 3 days. But what we see is that they'll advertise, we can do loans within 24 hours. And then, so that gets the client in, they sign up, they sign an offer, they usually might have to pay some fees. 24 hours rolls around and then, it would have been 24 hours, if this has happened, or we need this documentation from you, or we need just one more thing. And then it's another 24 hours, and then it's another 24 hours. And before you know it, the client is actually, they're locked in with that lender. They've already signed an offer so that they can't go and get it somewhere else. So it just means that they're basically getting them into their system. And if the loan takes 2, 3, 4, 5 days, or even a couple of weeks, well, they know they've already got that client into the system. So just be very wary of that. A great question to ask them is, how many loans have you actually settled in 24 hours? The answer is probably 0 or maybe 1%, something like that. The other thing we see is very expensive valuations, and also they're done for forced sale. So the purpose of the valuation is for forced sale. So what they're basically asking the valuer to do is discount this value of this property. So if it's worth $2 million, hey, we want you to come in at $1.8 million. So the other thing they're doing is that they're making a profit on that valuation. So the valuation might cost, say, $3,000, but they might charge the client $5,000. So we see this all the time. So just be very wary of the purpose of the valuation. So we like to see it where it's for market value or it's for mortgagee purposes, where the valuation is going to come back at what the property's worth, not under market value. Because you might have a lender that says, yes, we'll lend you 80%, but if they do a forced sale valuation and the valuation comes in really low, well, really they're only lending you 60 or 70% of what it's really worth, not the 80%. The last one that we see is cancellation fees. So where they'll get the client to sign a letter of offer, and that if the loan doesn't proceed for whatever reason, even if the lender doesn't want the loan to proceed, then there's a cancellation fee, and it might be $10,000, $20,000, $30,000. And what they will do is they'll have charging clauses in there where they'll actually caveat your client's property, and they basically hold it to ransom until you pay their cancellation fee, even if it's nothing to do with your client, if it's just the lender decided not to proceed with the loan. So they're just not to sort of, I suppose, scare you, but just to let you know what else is in the marketplace. And if you see some of these things where they're saying from rates and 24-hour loans, just be very, very careful. So in contrast to that, I just want to talk to you in closing about the PMA way. For PMA, we're all about, and our tagline is cleaner loans for better results. So we have low upfront assessment fees. We have no charging clauses in our indicative letter of offer, and we have no cancellation fees in our indicative letter of offer. So if your client signs the indicative letter of offer and for whatever reason they decide not to proceed with the loan, there's nothing else they need to pay. Any valuations are always done at cost, and we also do them at a reasonable value, so for market value or for mortgagee purposes. Any legal fees are also done at cost, and we have capped interest rate ranges, so you'll know exactly what the range of the interest rate will be. We also rebate any unused interest on extension payments. So if your client has, say, a 3-month loan with us, and they then, something happens and they need a couple of extra weeks, they might make an extension payment for a month, and then 2 weeks in they settle. So what we'll do, we'll actually refund them the extra 2 weeks that they didn't use in interest. The other thing we have is we've actually got custom built software. So we've spent a bucket load of money, over $100,000, building our own custom software that allows us to actually process deals faster and faster, okay? Because that's what private lending is all about, is that speed in which we can do it. We have a very high level of repeat customers, and that's something that's very unique in the private lending space, is that the customers have a good experience with us, and they keep coming back. So that's what we like to see, is a borrower that wants to come back and borrow from us again because they've had a good experience, and everything's been transparent, and it's been a good result for both of us. So for us, it's all about a win-win approach to lending. So guys, that's it from me. I hope that's been sort of helped you understand private lending, some of the things to look out for, but also how we do it at PMA. So if anyone does have a question, please pop it in the little questions box. Otherwise, if you do have a specific loan scenario, please send it through to our National Credit Manager, Peter Cuskelly. We've got his mobile number there as well as his email. The other thing you can do is check out our website, privatemortgagesaustralia.com.au. We've got a bunch of stuff on there. If you go to the resources tab, you can download our product fact sheet. We've got a one-page quick app form, so you can download that. We've got sample mandates, so if you want to mandate your client for some money, we've got a sample one there. We had a solicitor draw up, so you can sort of take that and use it as your own, and just have a look at some of the resources that we have on there. So, guys, I am conscious of time, so if you do have any questions, we might you can contact us with that. Otherwise, we will send you out some certificate, so you'll get a CPD point if you need that for your broking license, and a copy of the slides as well. So just so you can go back and reference it. The other thing we do is this video and this presentation has been recorded. We'll actually upload that to our website as well. So that'll be in the resources section. So if you just wanted to, play it to, some of your team members, or just something you want to recap on, you can go and have another listen to that. So guys, thank you very much for your time, and thanks for coming on board. We look forward to hearing from you soon. Thanks.